various capacities in this equities market from 2006 to today. And every day you keep learning something new. So today we are actually going to focus on the shares, and we want to look at what are these things called shares? What are the features of shares? Why should I have them? Why should I buy them? What benefits do they give me? And what risks should I know? What makes them interesting? So we look at a couple of corporate actions and what effects they have, just as considerations before you buy the shares. And then we would want to look at the main markets where they're traded, the primary and the secondary market. And finally, the most interesting aspect is the trading process. So before we start, I'd like to use the analogy of you going to the market where you buy, let's take an example, you're going to buy a goat. So you go to the market and you see this herd. What makes you choose one out of all the others? There are certain considerations that you'd want to consider. So for starters, there are two types of shares. There is the common share, which in the ancient times, let's say in the not so far past, individuals used to be issued with certificates. So you'd hear somebody say, I have a share certificate. And so this would be in a form similar to what you see there on the screen. And anyone who would buy, and that's what is normally traded, the stocks would get ordinary shares, which by effect means that once you own them, you also share equally on the risks and the rewards of the company. By that I mean, when the company makes money and issues dividends, you participate in that share. When the company gets suspended or winds up, that's a risk, you also get affected. And by the fact that you share equally, it means that you're more or less considered as the owner. So if there's any issue, then you will be the last one to be sorted out. And then there are other shares as well listed in the stock market. Actually, it's only Kenya Power and Lighting that has this type of share listed, known as the preference stock. This is almost similar to the common or the ordinary shares. The only difference is that you have a specific rate paid to you when dividend is being issued. And there are various types of preference stocks. So example is a cumulative preference, where if a company doesn't issue dividend this year and issues dividend next year, you will still be paid cumulatively what was owed to you the previous year. And the others that are not cumulative, meaning last year's dividend, if not paid, is lost. The other classes of preference shares, something like participatory, where you have a set percentage fixed to be paid, but if they have bumper profits and issue more than the normal profit, then you get to participate. However, the constitution on how or what defines a preference share would be defined by the company themselves. So each company would have in the articles of association what makes up a preference stock. But in essence, mainly a big chunk of what we trade is the common stock. So that's what we will look at more specifically. Now, in the current times, the Nairobi Securities Exchange, actually most exchanges in East Africa have gone, you hear of a term called DMAT, which means that now securities are tradable on in electronic form. You no longer get share certificates. So they're all automated. What benefits do I need to consider investing in the stock market? So in essence, what you're doing is you're actually buying a certain percentage of a company, becoming an owner of that particular company. And as you are an owner, some of the benefits due to you are the dividends. So whenever they get profit and issue dividends, you actually earn, you paid that money. Then you also have a right to vote. When the company is making decisions, major decisions, mainly shareholders are invited to vote during the annual general meetings or extraordinary general meetings. And as a shareholder, you have the right to vote. But your vote is equivalent to your holdings. So a person who has about 20% stake and another one who has 1% stake, the 20% stake holder would have more weight in votes than the 1% holder. Then capital gain basically refers to buying low, selling high, where you buy a stock at, say, 2 shillings and 50, it appreciates to 10 shillings, you sell, you get profit. Preemptive rights also means you're protected in the sense that whenever a company does any corporate action that would pose your stake at a risk of being diluted, you're given first right to actually participate. A good example would be like the rights issue. So when the company issues rights, you are first invited to take up the rights before they're issued to any other person. Risks. There's always risk in many investment. In the stock market, the main risk would be a price and market risk, meaning you buy and then the price goes down. I mean, like what's happening now, you find that because of the pandemic globally, most of market prices have fallen. So I mean, in the Nairobi Securities Exchange, you look at given examples. Early January, certain financial companies, say equity, KCB was trading at 55 shillings, 54 respectively, and now the price has come down to 31 shillings and 30 shillings respectively. So that's a risk that's there in the market. Liquidity risk, not all securities listed have the ability to enable buyers and sellers to participate on a daily basis. There are certain counters. If you buy, first buying would take time because there are probably nobody selling. Or if you want to sell, it may take a while before you sell. So that's also a liquidity. So you do also want to consider, are you buying a share that you can easily sell when you want to? Is there enough liquidity on that particular counter? Issue or risk. Basically, you want to look at the company as well. See, am I buying a company that has proven that it's a stable company over time? Or am I buying a company that I don't know about? I've just heard about it maybe in the news. I haven't done any much due diligence to find out whether it's a stable company. Because at the end of the day, certain things may happen that may cause certain companies to fall. We've got good examples. You've got certain companies on the stock market that are suspended for one reason or the other. And foreign exchange risks. So if you're a Kenyan in Kenya, this may not apply to you. But if you're a foreign buying stocks using foreign currency, so you're bringing in foreign currency and converting them to Kenya shillings, and then buying a company, and then later selling and then converting that money back into the original currency, sometimes you may get into foreign exchange risk where either the value of the currency you have has dropped, so you end up getting lesser profit or sometimes even a loss. Now, when we talk about things that affect the stock market, and mainly we look at corporate actions as the main drivers of price appreciation or price dropping, we consider what we refer to as corporate actions. And there are three types of corporate actions. One is a mandatory corporate action, where a shareholder, an already existing shareholder, has no option but to participate. So you'd find that once this has been declared, you automatically get to participate in them. And therefore, them at the moment, so there is dividend. So when the company issues dividend as a shareholder, an existing shareholder, based on the record date, you automatically get the dividend. When they issue a bonus, the same thing, a stock split and a reverse. So maybe just to explain a bit, dividend is essentially a profit paid out by a company. They make profit, and then they take part of that profit and distribute it to the shareholders. And there's always something to note. When do you actually participate in? There's some people who may realize that the dividend has been issued and immediately sell before the book closure. So there are certain things to remember during dividend. So there is the announcement date. That's the date that the company announces. Then there is the book closure date. That's the date they register all the people on their register as having qualified for the dividend. And then there is payment date. That's the date when you receive the money. And these are different dates. So sometimes you find that announcement is done in April, book closure is in June, payment is in August, November. So it varies. But it's important that you as a shareholder notice and mark those dates on your calendar. Bonus issues, we've had quite a number, especially this year, where companies have opted to issue bonus as opposed to cash dividends. So bonus is where you actually get extra shares without paying anything. So if you had 10 shares and they declare you get, for every 10, you get one more share. So at the end of the period, you end up with 11 shares. Yeah. Stock splits is where you have, let's say, 5 shares, and then they're split, say, into 2, and you end up having 10 shares. Each share is split into 2, and you end up having 10 shares. Essentially, stock splits are made strategically to increase liquidity and also to make the price of a stock affordable. You may find that stock is trading at say 500 shillings, and not many people are able to participate in that particular stock. So the company may decide to split it to have more shares in the market and effectively also reduce the price of the counter. And the same, the opposite is for reverse stock splits, which you find probably most of the time the effect of it or the cause of it is that the company has realized the stocks have become quite cheap, and they'd want to bring back the price to something a little more considerate. So they'd want to reduce the number of stocks on the stock market and so consolidate them. But essentially, all these corporate actions, the actual effect, the reality of the price on the stock market will depend on what investors perceive. So if the investors perceive that this particular action is positive for the company, then most likely, most often than not, the prices go up. But if they do perceive this is not good for the company, essentially, unfortunately, the prices fall. The second corporate actions are mandatory with options, meaning that you as a shareholder have rights to it, but you also have option on how you would want to participate. Good examples are rights issues, which are common in our history, where the shareholder has the option to either take up the offer or sell their rights or take no action, just ignore it. And then the other options, there are people, the shareholders who would take up all the rights due to them, and then also want to add and take up additional shares. Then there's also open offer, which is like rights, but unlike rights, you cannot buy more than what you're entitled to, and you cannot sell your portion of offered shares. The last one, category voluntary, where you are given the option to participate or not. So you're given an offer, like it's happened. A good example, for instance, was CMC, when Arthur Tain made an offer to take over CMC. Shareholders were sent letters to either accept the offer or not to accept the offer. So that's voluntary. And we've had a couple of takeovers and mergers in this market. I think one of the keen ones that people are watching closely currently is NCBA, merger between NIC and CBA. That's an interesting one to keep an eye on. So most of these decisions of corporate actions are made during an annual general meeting. That is decisions that are made public, and then an extraordinary general meetings may happen as well. It's always important to remember these particular dates. So, and shareholders, if you're a shareholder, you are normally invited to go and participate. So you can actually vote on some of these things. And also, it's also important to follow and find out what was decided, because that essentially affects how that particular stock price moves in the market. So there are two types of markets, mainly in the capital markets in Nairobi. There's a primary market and the secondary market. So the primary market is where a company is listing for the first time. Essentially, Kenyans know it as the IPO, and we talk about it. There's a lot of publicity, especially from the Kenyan IPO, Safaricom IPO. So most Kenyans, if you say IPO, they know what you're talking about. So this is where a company is issuing shares for the first time, and they would want to issue shares mainly because they want to raise capital. So what they do is that they issue these shares to the public, and in exchange they receive money which they can use to perform their strategic objectives, essentially then matching the funds that investors have to the opportunities that they have seen to grow as a company. The second is the secondary market, where you'd know that if I buy these shares from the IPO, I'll be able to sell them. And that's normally the mentality. So it actually allows the primary market to be effective, knowing that if I buy an IPO, after a while, I can sell them. And also it facilitates that two-way trading. Most of the time, the primary market, we don't have IPOs. So most of the times we actually trading in the secondary market. But always look forward to interesting primary issues. So now we go into the trading process, how it all works. You as a person or a potential shareholder would visit a broker and open a CDS account. So you'd fill in some forms. Each broker has their own requirements for opening a CDS account, but fundamentally they have to comply to the NSE and CDSE rules. And then once you have made an application, your application has been approved by the broker and your CDSE account has been generated, then you are able to place orders. So if you're buying you have to fund your account, then buy the share. If you're selling, you just give instructions to the broker. Now there are online platforms and you're able to sell. And then you'll be able to withdraw the money that you want to get out or fund your account, as I initially said. So unfortunately, or fortunately, that's how the market works. You have to go through a broker. And the broker then connects you to the stock exchange and the CDSC as well. The broker's job is to ensure that your application complies, first of all, with the mandates for opening an account. And then secondly, to facilitate that your orders are executed. And if you need any information, in terms of statements and what's been happening to your account, they will be in a position, because they keep that record for you to facilitate and give you to see what's happening. In addition to that, they also offer insights on the market. This is the job we do on a day-to-day. So what's happening to this particular company? What are the prospects? Why was this decision made like this? So some of the elements that we will tackle. The broker connects to the Nairobi Securities Exchange. The Nairobi Securities Exchange hosts the trading platform and then oversees the day-to-day trading, where you'd be able to buy and sell. And their system is quite advanced in the sense that, unlike the ancient days where you as a client would place an order and wait for a period of over 30 days and constantly keep calling the broker to find out, has my order gone through or not, what's happening. Now the entire process is automated. In a couple of seconds, you get to know whether your order has been executed or not. I'll cover how that happens shortly. Then the Nairobi Securities Exchange and the CDSC are tightly coupled. So when your trade execution occurs, the booking is done in a matter of seconds at the CDSC, and it reflects instantly. Yeah. Then there's also something referred to as a settlement cycle. So in Kenya, specifically in the Nairobi Securities Exchange, whenever you purchase or sell a stock, you have to wait until the third trading day for something called settlement, for it to settle. Meaning, if you have bought those shares, if you bought shares, you will get those shares reflecting in your account on the third trading day. Yeah. If you have sold shares, respective amounts, money, physical money from the proceeds of a sale would be received by the broker on T+3. Yeah. And this element here, the CBK, is what we know as a settlement cycle. So whenever all trades accumulate, you can imagine there are a couple of thousands of trades happening at the broker's house. And these brokers are quite a number, about over 10 brokers. So each trading with each other. By the end of the day, there's a position. Either one broker is being paid by the other, or they're paying another broker. And of course, you have to pay NSC and CDSC and CMA. So at the end of the day, from an accounting point of view, there's somebody who owes another. And that is what is referred here to as the settlement process. It's automated now. It's actually done very fast on that level. So we get into the trading session. The Nairobi Securities Exchange starts the trading session on any trading day at 9 o'clock, and it operates until 3 p.m. But there are sessions, and there are things that happen during these sessions. So the first session is a pre-open session, which is a more or less 29-minute session. This is where they open up the system, and you'll be able to enter limit orders. There are a couple, mainly two types of orders. So a limit order is an order that has a specific or a specified price. Then there's another order that is referred to as a market order. Or people also know it as the best order. That's an order that doesn't have any price. You just say, buy at whatever price the market is trading at, or sell at whatever price the market is trading. A little bit risky at times, but if you want quick execution, market price would do. Limit price, you actually set a price and say, I will want to buy Safaricom at 27 shillings or better, meaning you will get sold to at 27 or any price below 27, nothing beyond that or above that. Those are limit orders. So the pre-open session allows for only limit orders, and no trading occurs here. It's just like people getting into the market, so you're bringing in your orders, and no trading occurs at this particular point in time. And immediately after, for 1 minute, the power of technology is amazing. All those limit orders that have been placed 30 minutes prior are matched. During this session, it's more or less like the system is locked. You cannot put any more orders into the system. So all the orders are in the system at that point in time are matched together. So you've got the buyers and you've got the sellers. So where the price agrees, a trade is executed. And where the trade is not, does not occur, those orders are queued. I'll explain soon on how that happens. And then they also have, there's an algorithm that has been set into the trading system that generates the opening price for the day. And then at 9:30, the market opens. So all other orders can be placed. There is another order as well I need to mention here, referred to as odd lot order. This is orders that are below 100, multiples of 100. So you may have shares that are, 1 share, 2, 99 shares. Those ones are traded as odd lot orders and can only be entered into the market during this session. So in the open session now, you can now put all the other orders, limit orders, market orders, odd lot orders. And then market continues operating until it closes at 3. As I had mentioned earlier, there's a settlement cycle. So if you trade, if you place a trade, it settles on after the third business day. A good example is, so if you trade on Monday, for example, that's the day that you trade, the settlement will be on Thursday. So whenever a broker would tell you, somebody talking to you tell you settlement is T+3, then now you understand what that means. Whenever you trade, there are transaction charges. And this is how, all the participants who facilitate this make the money. So you get charged a brokerage fee of 1.76 if the trade consideration is less than 100,000. By that I mean you take the quantity times the price. So if you have 100 shares buying at 20 shillings, that's 2,000. 2,000 is below 100K. So you will be charged 1.76 brokerage. And if you're trading any quantity that is above 100K, then you'd be charged 1.36. 0.38%. This is automated. It's in the system. And unlike initially when we used to be able to, before the automation, we would say only buy a block. The system now is automated and orders are served on first come first served basis, price, and then time priority. So you are not guaranteed that when you place the order, if you're buying 200K or selling 200K, you will get sold that quantity as is. You may be sold the 200K in small quantities to make it 200K. So there's no real guarantee that you'll be charged 1.76 or 1.78. And then you're also charged an NSC transaction levy at 0.12, CMA transaction levy at 0.12, CDSC transaction levy 0.08, CMA guarantee fund 0.01, CDSC guarantee fund 0.01%. This was introduced, VAT on brokerage was introduced in April this year, if I'm correct, where you're charged 14% off the brokerage fee. So if your brokerage fee came to about, say, 2,000, then that 2,000 is also charged 14% for VAT. And then the stamp duty, so 2 shillings for every 10,000 traded. If you work it out, how much you're charged at the end of the day, it doesn't come to more than 2.5%. It's mainly between 2.1 to 2.5% of the transaction. Now, I always I argue with people and tell people, where else would you be charged this low? You know, I mean, if you go to the market to buy a commodity, a supermarket or a shop, a commodity you're buying already, VAT is 16%. Yeah, 2.5% for buying a share. Hey, it's considerable, cheap. Now, how the market works. So, as I had mentioned earlier, whenever you're buying or selling, your order can either get executed or it can get queued. So this is a good example here of what we refer to as an order book. I took this from a site here, quoted, My Stocks Plus. You can visit it. It's a subscription-based website, but it gives very good information on the happenings in the stock market, Nairobi stock market. So I took, this is actually what happened on Friday, Safaricom trading. You find that this, at the point in time I was taking the screenshot, there were bids. Bids means people who are buying. Yeah. And as you can see, they are arranged on a price manner, with the most expensive buyer getting the top priority. Yeah, this is on the buyer's side. So in this particular case, at this point in time, there were 225,000 bids, meaning people, this quantity of buyers buying at these levels. So there were 3 buyers in total buying 102,100 shares at 28 shillings. And then there was one buying 1,000 at 27.40, and so on and so forth. And then on this other side, there were sellers. Sellers selling 39,500 shares of Safaricom, and the cheapest seller is put on top, so that it's easier to match a cheaper seller to the most expensive buyer. But these two are not matching, because this one wants to buy at 28 and this one is selling at 28.45. So unless they agree on the price, this trade will not happen. They'll just be queued. But there are others who came before this lot. The others who came before, you can see at 14, 49 and 37 seconds, there was 100 shares traded at 28.40. at 2:58 and 28 seconds. There were 1,500 shares traded at 28.20. So these were orders that got matched. The buyer and the seller, had a similar price, and the trades got matched. So essentially, that's what happens. The other things you also look at: what was the previous price? What was the closing price? What is the change today in terms of the previous price? So at this point in time, and this keeps changing second by second, at this point in time, the change was 0.5% upwards. What was the highest price of the day? 28.40. What was the lowest price? So if you're considering buying, for example, you would not want to buy at a price that is higher than today's price. Yeah. Unless you're really desperate or you really have your own agendas of buying the stock. But this, you would want to consider high or low, and decide where would you want to place your price at. And then there's volume. How many shares have traded today? So you see, at this point in time, there were 11.65 million shares traded of Safaricom, which also talks to liquidity. So sometimes you want to look at all the counters that have been trading in the market and just look at the volumes and see which counter is liquid. Yeah, the VWAP, the weighted volume weighted average price, basically the average price of the day at that point in time, 28.20, and number of deals. Turnover is basically the quantity plus the price. The turnover is quite big considering our market. Then as you go on to trading, it's always important to have an idea of what you're doing, an objective. What do I want to achieve? I have seen by my experience people going to the broker to buy because they have good intentions in terms of saving or generating wealth, but they may have not thoroughly sat to think through what they want to achieve, or they did not have guidance to actually come up with a goal. And it has been my experience when you go with that and ask the broker to what is the best thing to buy or what is the best thing to sell, without taking time to understand where you're coming from and where you want to go, you would end up buying what is being sold, what is hot at that point in time, or selling. Yeah. So it's always important to realize, where do you want to go? For example, you could say, I want to have 10,000 shares of Safaricom by the end of 2021. Yeah, that's a long-term target. But how do you achieve that? You then say, I will be buying 500 shares of Safaricom every month for the next 24 months. But as you are buying, you also want to realize, at what price am I buying at? So you see, I want to buy Safaricom, but I'm not going to buy it at the highest price. I can wait. So I'll just keep putting in money and wait for the price to be right and buy it. I just keep putting in money, wait for the price and buy it. When the price is high, I'm not running after the market. I will wait. Yeah. So in essence, we say you have a long-term target with short-term goals. That's always important to have that. Now, the specifics of how or to arrive at a goal is individual. So each one, based on the circumstances, would arrive at the long-term objective and the short-term goal. Yeah, that's one good approach to come up with a strategy, trading idea. Then you also find that you'd have given strategies. You're told There's an aggressive strategy, there's a conservative strategy, there's a moderate strategy, and specifics given to it, varying across investment advisors and stockbrokers. The basic logic I would suggest is invest your age in the stock market. Mainly, if you're 20 years old, over 100, so you would say 20% of your investment is in conservative stocks and 80% aggressive. But if you're 80, it's vice versa. You don't want to take a lot of risks. So you'd want to consider stocks that are more or less guaranteed. And then 20% you can now take on the risks. Finally, I'd want to finish the presentation by some quotes from Warren Buffett, just for your consideration. During this time of the pandemic, there is a lot of fear in the markets, and you've been seeing what has been happening. The prices have really gone down. And he says that widespread fear is your friend as an investor because it serves up bargain purchases. And it's a reality. There are certain stocks that you look at on the stock market and their price are just really low. But you also, something important to point out, as he says here, only buy something that you'd be perfectly happy to hold if the market shuts down for 10 years. So when you're buying in the stock market, as I had mentioned earlier, have a long-term objective. Do not put your money with expectations that in 3 months, you will make 100% killing. Be realistic, know that if I buy this stock with this money, this is not my rent money, this is not my emergency fund or emergency. This is money I'm saving. It's more or less like a saving that I would expect to get a return in the next 3 years. And also consider the economic circumstance. We are now at a unfortunately low end of economic progress because of the pandemic majorly. And then sooner than later, we are running into the election period. Politics checks in. Yeah. So also realize that you are making an investment to get a return maybe at least 3 years later. Yeah. But as you do that, you also have short-term targets. So if you have a mentality of that state and you're buying Safaricom, for example, for argument's sake, you buy Safaricom at 26.50, it goes up to 31, you have made a return of about 8 to 10%. Start considering whether you want to sell. Yeah. And if you do sell, wait for the counter to fall again and buy it back. And this can happen within that period of 3 years, but your mentality is long-term. So you don't get to start panicking. Then as a parting shot, he says as well, the stock market is designed to transfer money from the active to the patient. It's a patience game. That's why I'm saying long-term objective. Thank you very much. I now would welcome any questions you may have.
Thank you for that session. We'll move now to questions. There is one question here on what's the difference between investing and speculating, and should you buy individual stocks just because you think they will go up at some point?
Should I take a question as they come?
Yes.
Okay, so what is the difference between investing and speculating?
Yes.
Now, in the stock market, as I had mentioned earlier, people come there with different objectives. So you'd have somebody who's coming to buy because they want to increase their stake in a company. So the guy has, this person has, say, maybe 0.1%, and they want to accumulate until 2% stake. This is an individual who has a totally different agenda in terms of, or outlook towards buying. There is another one who wants to buy because they are 30 and they want to have a plan that when they reach 70, the dividend they are earning from their investments, the investment they made over the years, is enough to pay for their lifestyle. So you find an individual has bought shares from zero over 20 or 30-year period. The person has 1 million shares of a certain company. If this company pays 2 shillings as dividend, that's 2 million shillings paid to the person in his later age. And that's enough to cater for their lifestyle. And then you have another person who wants to grow. Basically, they're putting in money and they want to buy and then wait and sell and then wait again, buy when it's low, sell when it's... So these are persons who are growing slowly. Yeah. So investing, I would look at it as, is it intelligent investing? Are you finding out first what you want to achieve? And then secondly, are you researching on what you're buying? Or are you just buying because somebody told you? Speculation is also a part of investing. Yeah. But is it intelligently done? Are you just hearing without doing further research and running to buy? Essentially, I would say best practice is to do your homework. Yeah. And normally, as a starter, I would advocate, when you start investing, if you're new at investing, start with one company. Out of the many listed companies, choose one and buy this company, research it, read on it, grow, and as you're learning, by the time your portfolio reaches, say, 500,000, you've actually understood pretty well what it takes to invest in a company. And then you can add up to 2, 3, 4. I would always suggest, don't buy more than 4 shares, 4 companies rather, in your portfolio. In my experience, I've seen someone who has, or people, investors who have over 32 companies, even if they have invested millions. If one company makes a return of 100% and they are thinly spread, it would not have an impact in their portfolio. So invest in few companies, buy into few companies, and that also forces you to research and to actually choose the companies properly, not because of emotions or feeling or what you're told by a friend or what you heard on the news, but you've actually taken time to select that company. I believe I've answered the question.
Yes. The other question is, what do you consider conservative and aggressive stocks in the current market?
I would say that is, if I look at it from the angle of dividend pay, for example, and performance over history. If you look at the financial sector, for example, look at companies like ABSA, which has had the highest dividend yield over, you're buying a stock at 9 shillings and they're paying you 90 cents. Automatically, you have a 10% return. Yeah. Based on dividends. And this is a company that has proven the test of time. They have been running the operations for a while. Look at the likes of KCB, Equity. Look at East African breweries. These are companies that you'd know are more or less stable as funds. And this would be counters to consider and you can put them up as a conservative stock. So you'd want to look at, has this company been paying dividends over the years properly, consistently? And you also want to look at, how has it been performing? What is their strategy going forward? And is it an innovative company? Is it constantly innovating? Is it coming up with new things to get market share? Good examples as well is a main company, Safaricom. You know, every other time there's something new coming up. You know, so whenever you're considering stocks, look at companies that are going with the times, if I use that phrase. And aggressive. Aggressive, I think this is personal, you know. There are certain counters, maybe personally I would not touch, even with a 10-foot pole, but another person would touch. You know, you'd hear, for instance, companies that have, they're in trouble, you know, but somehow someone is hopeful that something is going to happen to change. You are not sure of whether, if it's a bailout, for example, whether it's actually going to be a positive or not. You're not guaranteed, in quotes, that if they get that money, they're going to continue doing, or they're going to do well, they're going to turn around. But because of the fact that you've heard they're going to get that money, you jump in and buy that stock. That's a little bit aggressive, if I may mention. Yeah. And you look at companies who are struggling, but yet you know they're struggling. You know they're in an industry that is actually in its knees, but yet you decided to invest because seemingly the price is low, and hopefully you make a killing. That's an aggressive approach to it.
Yeah. Okay. Earlier you had stated that you'd advise buying one stock at a time. So there's a question on indices.
Yes.
Is it advisable to buy indices because they cover, well, you'll have a pool of more shares, more companies, or do you just go with a strategy where you buy one company stock at a time?
Okay, so in the Nairobi Securities Exchange, the listed stocks, we don't cover indices in terms of buying and selling. That's not in the segment of stocks. That's a different product offered through derivatives, which not all brokers trade. Just a few trade in that space. So for this session, I'm just covering the stock market. This is basically individual ordinary shares listed on the stock market. And hence that suggestion. Do not buy the entire stock market. Just concentrate on a few that will make you money.
Yeah. The next question is on apportionment of dividends.
Yes.
Are they carried out with regard to the period in a year that you have held as a shareholder during dividend distribution?
You might not even have shares of that company until they announce. So when they announce, they issue something called, they basically indicate or state a date. It's known as the book closure date. Mm-hmm. So you run to buy those shares before book closure. You know, well, of course, the risk then is that you may buy them expensive because most people know. But the idea is this, that whether you had the shares or you've just bought them, you must have them before the book closure. Let me give you an example. Safaricom issued a dividend payout of 1.4 shillings per share in August. The book closure, if I remember correctly, was 31st July. Let me just confirm that. Yeah, I think 31st July. Yeah, I think that's right, July. And the payment is 30th August. So by 31st July, if you had bought those shares or if you held the shares, then you qualify to be paid dividends. Yeah. If by that date, the date closes like this and you don't have those shares, you don't qualify. If you had them and sold before that date, you do not qualify to get dividend. So dividend is only paid on the shares you hold at that date. It's called the record date or the book closure date. Yeah. And there are two terms that are used. So whenever you're looking at the stock market or the price list, always refer to this. There is come dividend and ex dividend. Come dividend means before dividend payment. So whenever you're looking at the price list and you look at a counter, you'll see it's written there, CM, means that counter or that security is trading come dividend. If you buy it during the come dividend status, you qualify to get the shares. Then when they close their books, immediately before payment date, that period after closure and payment date is referred to as ex-dividend. So when you see when you look at the price list, the Nairobi Securities price list, and you see it's written EX, ex-dividend, it means if you buy the shares on ex-div, you don't qualify for the dividend. Yeah, I hope I'm clear.
Yes, I think you've answered Theuri. There's also here on rates. Rates was introduced in the past in the Kenyan market. Is this an avenue you can advise on to go into, given it's barely 4 years? And what approach would you advise, conservative or aggressive?
Rates is a good counter to, I mean, they're actually only one now, Fahari I rate. In essence, you're getting exposure to invested real estate assets through this vehicle. And I would say at the moment it's a bargain because prices have really come down. So it's a good option to look at. In terms of whether it's aggressive or conservative, at the end of the day, I would also want to say that is actually it's a subjective element in the sense that being aggressive to you may be conservative to me, or vice versa. So you individually, are you comfortable taking that risk of any investment that you're making? So if you're comfortable taking that risk, in essence, it could be a conservative risk for you. If you're not, but yet you go ahead and invest in it, then you're being a little aggressive. So at the end of the day, subjectively, but from an objective point of view, if I look at the I rate and how it's being managed, I would say that they are doing a good job. I would also urge you to look at the published financials, their annual reports, and for you personally to understand how it works, including the real estate sector, because that is the space that they are playing at. In their particular real estate assets that they hold and how they manage it, plus how they have gotten income. And you also want to consider, are they paying dividends? Have they paid dividend? How much? Are you comfortable with that amount of dividend that they are paying? And if you are to put the same amount of money in another counter, would you get better return? Those are things that you would want to consider. Yeah.
Okay. On the transaction fees, since you said they are standardized, since there are different stockbrokers, when you're looking for a stockbroker to engage with, what should you ideally look for, or are they all the same?
No, they're not all the same. It's the same thing. If you're choosing a bank account to open a bank, you have all the options: Barclays, Standard Chartered, Stanbic, Cooperative, KCB, Equity. What would make you choose one over the other? Most of the time, it's service and convenience to you. So you'd want to look at broker after broker and see who's actually giving better service. Because at the end of the day, when it comes down to trading, it's the same. And most of them now have been automated. Most of them use actually the same system. But at the end of the day, systems are run by people and policies and procedures. So who has a more efficient policy and procedure, and who have a better service-oriented culture than the other? At the end of the day, are you happy to be a customer of this broker? Plus, there's always a choice. Capital markets has provided for that you can always, if you're not happy with the service of one broker, you can always move to another broker. Yeah, you're not fixed to be with one broker for life. You can always move from one to the other. Also, sorry, just to mention, what I had listed are fixed charges as per trading. So as far as trading is concerned, those are the fixed charges. There are some brokers who have introduced additional charges. So you need to also investigate and query the broker before you open the account. Do they have additional charges? I mean, there are some brokers who have annual maintenance fee. So every year they charge you, whether you trade or not, or whether you've made money or not, they'll charge you a certain amount. There are others who charge you when you trade. If you've been dormant for 8 months and on the 9th month you trade, they charge you a fee. So there are other charges that occur during, I mean, that other, some brokers levy. So that's also important because it's your money.
Still on the brokers, what is the process of moving from one broker to the other?
So you'd go to you'd approach the new broker, the one you've just selected as a new broker, and open an account with them. So once they've confirmed that your account has been opened, you will then go to your broker, the one you're moving from, and inform them that you want to move. They will fill for you a form referred to as a 4A4B, a transfer form, 4A4B, and process it when it's ready. Some do it immediately then. There others will take a couple of days to do their reconciliation, and then when it's ready, they'll tell you, you go pick up the form and take it to your new broker. Then your new broker will process the form, and your holdings will then be transferred to the new broker. Then can continue trading with the new broker.
In terms of when you're investing in stocks, is it a dividend stocks better than capital gain stocks?
Yes, you can. I mean, you can. Why not get both? Buy a stock that is giving you both dividend and capital gain. That's a win. You'd want to focus on areas that you actually, because at the end of the day, it's a probability. It is given that in the past, this company has been paying this dividend this way. So they have a dividend policy, and we hope most of the time that it is consistent. Yeah. Let me give you an example. Barclays have been paying consistently at least 9 to 10% dividend for a couple of years. Equity Bank has also been paying, but this year they didn't pay. So if you bought equity hoping to get dividend this year, you didn't get the dividend. Yeah. But year by year, companies try their best to remain with a certain set dividend policy. And in the event that they don't meet that policy, they always tell you why. I mean, Equity said, rightly so, because the circumstances that are now, they're conserving their cash, which is understandable. Now, capital gain. If you're buying a dividend stock, most of the time, if you get it right, if you get it at the right price, then you definitely get profit. If you look at the financials at the moment, just look at them. If you're buying those stocks now and you're patient enough to wait, wait it out for this thing to end, and then also for our elections to go through smoothly. Trust me, at the end of that period, you will be making some good money.
There's one here on, if yourself you were to invest in stocks during this period, what would be your top 3 counters?
Top 3 counters. Okay, for me personally, Safaricom is a must. That's a company that I must have. I accumulate that, and then I'd look at the banks because they're really really cheap. And the top I'd look at is ABSA. I'd look at is Equity, KCB. I'll also consider NCBA. Yeah, but NCBA, you would also consider it with keen interest in the sense that keep looking at what is happening to that transaction. Yeah, but I'd want some exposure there, and I'd also want to capture East African breweries at a low price, because I mean, at the end of the day, the bars will be open at some point, and people will still make East African breweries will continue generating money. So at the moment, I think those are my top picks.
And would you expound like why? Because you just told us why would you pick Safaricom, Absa?
Uh, Essentially, I look at three main things. One, as I had mentioned earlier, what is the history of this company? Have they been doing well? And yes, for all of them, they've been performing well. Two, I look at their dividend policy. Have they been paying dividend? Worst case scenario, I still get paid some dividend at some point over the years. And then lastly, I also look at innovation. Is this a company that is happy with the status quo, or is this a company that is constantly bringing news? If you look at ABSA, KCB, Equity, Safaricom, East African breweries, if you think back the near past, there must have been something you heard about some initiative they are doing. They're constantly innovating. They're not if I use the example of Kodak, who just sat back and said, these things will pass. People will still continue buying cameras. No, these guys, they're constantly looking at what can we do to shape, what can we do to improve the lives of Kenyans, and at the same time make money while they're at it. I want to be part of that kind of company.
Okay. Could you please share a list of the brokers?
There is a site. If you go to the Capital Markets Authority website, there's on the Capital Markets Authority website, there is it's called the list of licensees. There is a PDF you can download, and it lists all the licensed stockbrokers and investment. Actually, let me just clarify: there are two types of you would refer them to as stockbrokers and investment banks. So a stockbroker, from a licensing point of view, is limited to just buying and selling on behalf of customers. They can't do anything more. An investment bank, you'll see there's a section there written investment bank. An investment bank can buy and sell for brokers, can advise companies on listings and structuring and mergers and acquisitions, and they also have their own book. So they have, in terms of even capital, an investment bank has put down more capital than a stockbroker. So if you see a stock brokerage license and an investment bank license, there's a difference. I would also I would be keen. I would suggest look through getting your accounts with an investment bank, but that's my personal preference. Anyway.
Okay. There's also are you charged any fee on the transfer of holdings from one broker to the other?
Oh, yes, sorry, I forgot to mention that. Yes, you're charged by CDSC. CDSC charges 200 shillings.
Mm-hmm.
Yes.
Also, that's the only fee that applies.
That's the only fee that I know of. So your broker would ask you to fund your account. So where you're transferring to. So the person receiving the your holdings will ask you to fund your account with 200 shillings to facilitate that. Not where you're moving from. Where you're moving from, hawa wamekusahau, wamekuacha. But the one you're coming to will then facilitate the transfer and pay CDSC 200 shillings on your behalf.
Okay. Then can you give any insights into fundamental analysis, like charts, candlesticks, specific for the NSE?
Um, we are getting there, you know. We're not like the foreign markets yet. We haven't reached there, but we are getting there. I mean, I've seen platforms that have those candlesticks. They've got parabolic. They've got Bollinger Bands and such. And those are really active markets. I mean, they have reached a level where you can actually achieve day trading. You trade in a few seconds, and the next seconds you're able to buy and sell. I mean, but we haven't reached such because first of all, our settlement is still T+3. However, there's an initiative that is being carried out, stocks, borrowing and lending, which hopefully, if it goes through, it will get us closer now to that approach. The fundamental analysis and technical analysis that we do at the moment is just to look at the price history over time. The site I'd mentioned earlier, lives.mystock, has good tools to actually look at the price charts. They're not candlesticks at the moment, it's just a chart. And then also fundamentally now we look at the annual reports, we listen to any press releases, and we also read research by other analysts. So brokerage firms would have a research department with specialists who offer their opinion and analysis about different companies. So you look at all that and then you make your own personal opinion.
Okay. What are your thoughts on purchasing government securities through stockbrokers as opposed to direct from the CBK?
By government securities, I believe you are referring to fixed income, bonds,
Yes.
and treasury bills.
Yes.
So I was just covering stocks at this moment, but just to mention, I think most would give you two options. So you can buy directly. Actually, the primary offers, you go directly. But the secondary offers, you can buy. You have to actually buy through a broker, select a broker, but you must have a CBK CDS account. Now, the broker will buy for you on your behalf, and then get that particular security, or rather fixed income paper, credited to your CDSC and CBK CDS. Or there are banks that have a collective pool, so they actually buy on your behalf, not 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 individually. Sometimes there are benefits either way. So if they buy on your behalf, it means there's actually liquidity. So the chances that you may have a problem selling or buying is minimized. But if you're buying individually, it may take some time before you get the paper you want. Yeah. Or it may take some time before you sell the paper you have. Yeah.
Okay. Maybe you can also tell us a little more about what JD Mali is.
So JD Mali is an authorized agent of SBG Securities. SBG is an investment bank rather of owned wholly by Standard Bank Group. So they're same part, they're like brother and sister to Stanbic Bank. So that's where JD Mali, that's what JD Mali is all about. And we suggest strategic goals and investment plans in the stock market for investors through SBG Securities. We are also exposed to Uganda. So for people who are investing in Uganda or who had already invested but have no way of going forward, especially in Stanbic Bank Uganda shares, we assist them through a broker in Uganda called Crescent Capital.
Okay. There's a question here on if I wanted to invest in not local stocks like in Kenya, maybe let's say other counters, international counters. Is that possible? And
It's
if
possible, but not through the current channels. So I mean, like I said, JD Mali, we are in Kenya and Uganda through partnerships. Yeah, internationally, London, Washington. I mean, US, New York rather. I think currently you may just search for other brokers who do that, but my partners don't do that at the moment.
There's here, how does interest rates, CBK related actions, MPC influence the stock exchange? For example, in election times or recessions?
You see, the stock market globally is affected by, think of it this way. People have money, and this money is being competed for by different investment options. So you have, let's say, 1,000,000 shillings, and this 1,000,000 shillings you want to invest. So you're torn between, do I put it in bonds? Do I put it in equities? Do I put it in money markets? Do I put it in, unit trust? Do I buy land? So your wallet is always always has competing investment options. And as an investor, you would always want to look at where will you get the best return compared to all the rest. So sometimes what happens is this, the cycle. When the government bonds and let me say the government instruments are doing well, most of the time the stock market is not doing well. So you'd find people running to buy government securities. In fact, they are secure and they give you a certain fixed return. However, the equity market is high risk, high return, meaning those who are investing now, for example, have a higher chance of getting a higher return. And that means then that when the stock market starts moving up, interest in this other side starts going down. And people jump into the stock market and it just shoots up. So you always have to look at where are you getting the best return at that point in time. Yeah. And always, it's always important to peg your return on the T-bills. So there's no point in you coming to the stock market to get a 5% or 6% return, taking all the risk, yet that particular money you'd have put in T-bills, gotten that return without stress of thinking that you lose your money. So whenever you're coming to the stock market, always have a target higher than the T-bill. Always invest in a stock that you, when you do your analysis, the probability of getting at least 15% return is higher than, rather is higher and also worth taking that risk. Yeah. Always peg any other investment that you're making and including now specifically the stock market, to the T-bills, because they give you the minimum return that you're supposed to get. Yeah.
Okay. There's also, like, for the merger that when KCB acquired National Bank,
Yes.
will that influence the share price of KCB and its dividend policy?
Yes, as I had said earlier, any corporate action done by any company, if perceived to be positive for the company, the stock prices move up. If perceived to be negative for the company, the stock prices always go down. So initially, when this news of the acquisition was being circulated, we had seen the prices going up because there was clear understanding of the positives of the acquisition, including, just to mention a few, easy penetration of those markets that NBK was already, easy acquisition of assets in the sense of accounts and also physical assets. So in essence, if you look at KCB's balance sheet thereafter, it was better than before the acquisition. There was positive sentiment about the acquisition, and the price of the counter was moving up. Yeah. However, because of what has happened in the economy and most economies slowing down, that has affected the stock market prices. So the prices have come down. But fundamentally, if you look at it, the acquisition was a good thing. And if you actually strategize and position yourself strategically, when the prices go back up, you'll be making a profit.
Okay. Standard Chartered Bank and NCBA did bonus share recently. Are these credited to the CDS accounts immediately, or one has to check with the registrars? And then additionally,
there's always an announcement. Sorry, did you finish the question? Sorry.
No, there's also the bonus share. Do they add any value to you as the investor?
So whenever there's an announcement, even for the bonus share, there's they actually state the crediting date. Yeah, they indicate there that that the particular counter was or will be credited on a particular date. So, for example, if you look at the what do you call it? It mentioned Standard Chartered. Just trying to find that particular announcement. They would mention at the end of the announcement, they would mention the book closure date and the crediting date. And sometimes the crediting date would be subject to approval. They'll actually put it there, which means they have not specified when they're going to credit it. Yeah. And as you continue following up the particular the price list every single day, at some point, they're actually going to indicate the date of crediting. So more specifically, you're talking about, just remind me, which counters?
Standard Chartered and NCBA.
NCBA. I have to check that. I don't have it offered. Forgive me for that. I have to check that and then get back to you.
Okay. There's a personal question here where by Galaxy A6, a stockbroker analyzed a sell order for the Standard Chartered Bank counter at 154 and they bought it at 178. So the question is, should he cut his losses or wait and sell, or wait to break even?
Sorry, just come again. You bought the shares at
178 and currently they're at 154.
Yes.
So
okay.
Should they cut losses or wait?
Understood. Okay, so there are, whenever you're buying or selling, there are certain facts that you need to consider or attitudes that you need to approach. and let me share them with you. So these are this. When you're buying a share, it is important that you set profit targets. Meaning, if I buy, in this case, Standard Chartered at 150, at 178, I'd want to set a target to see what will be the price of Standard Chartered for me to get a 15% return. So you calculate that. And also remember to include the costs, which are initially the transaction charges, so that you're getting 15% real return. So at 178, you may get 15% when Standard Chartered reaches a price of 196. That's at the top of my head. So every day you're watching the news, just keep watching to see it as it reaches 196. If it reaches 196, you have to make a decision. Are you going to sell it? Are you going to hold? Or are you going to revise your return from 15 and move it higher to a target 2, like a 20% return? Yeah, with a trailing profit, in the sense that you're at 15%. If it falls to 12, what do? Do you wait for it to continue falling, or do you just sell it? Now, second approach is on the downside. You also have to put, whenever you're buying, just before you buy, you also have to put within yourself loss targets. What am I comfortable losing? So before you buy, you say, I'm buying this at 178. If it drops by 10%, you have to consider, am I comfortable with that loss or not? And you also need to decide on 3 things. 3. There are only 3 things. The first thing is do nothing. Okay, it has fallen, sour. I will wait for it to come back. The second thing is, as you're saying in that question, the person is saying, cut your losses, sell. It has gone to 10%, sell, and then come back. You live to fight another day. The third option is what I prefer. Whenever I'm getting into any stock, I always consider the third option, but that's my personal preference. You have yours, you have to make yours, which is, I will revise that loss. So if my loss was 10%, my target loss was 10%. So I've reached 10%. I say, okay, I'm going to revise this to 20%. Let us see whether this price will be realized. So I bought at 178. It's now 150. 150, it's more or less about maybe 25%, 15, 20% loss. So I'll say, let's see whether it will go to 30. It goes to 30, I start thinking, is it going to fall further? Yeah. If I think the chances it will continue falling further a little minimum, and even if it falls, I don't think it will go any lower. I come in and average my price, average down my price. By that, I mean I come and buy more at the lower price. So I've bought it at 178, and now it has come down to say 130. I'm coming in and buying more shares at 130. So what happens to my 178? It comes down to even 140 or 150, depending on how much more I buy. So I'm averaging down, which means that when the price goes back up to 178, I am in profit. That's the strategy I take. You have to decide yourself, what are your profit loss appetites, and are you willing to wait? Are you willing to cut your losses, or are you willing to average down? Those are the only things you need to consider.
Okay. What are some of the potential companies in Kenya that offer, that are liquid? Like in cases of rapid fall in prices, you can exit the market.
Oh, sorry, come again. What are the liquid stocks?
Yes, liquid stocks.
Yeah, mainly Safaricom, we start with that. Equity, KCB, those ones are really liquid. In essence, when you look at liquidity, you also look at the number of floated shares. ABSA is another one that has a lot of, liquidity. You can easily get in and get out. And also you look at something also to refer to, just to note, the MSCI index that also gives a good indication of what foreigners are also looking at.
Okay. Uh, Thank you for this session. For those who still have questions, you can still reach out to Vasili. Maybe also, Daudi, you could share your email in case anyone wants to reach out.
Yes, certainly. I just put it here. My email is 1 minute. My email is dmpu. For those who have a pen, dmpu THIA
Mm-hmm.
DMPU THIA translates to D Mputhia, Mputhia with a P, at JD Mali, JDMALI.com.
Mm-hmm. Okay.
So that's
Thank you.
dimputhia at jdmali.com.
There's one last question. There's a question here.
Yes, please.
Uh, there are some companies that are expensive, like the likes of BAT, EABL, and I think also Kakuzi, and they have very nice dividends. Is it better to save to get these companies or just buy what you can afford?
First thing I would ask is very nice dividend is relative to what? I mean, if you need to look at the dividend yield. So it may look like much, but if you compare what you're getting against the price of the stock, is it really very nice? I mean, if you compare the price, you get 6% or 7%, and you look at another one that is a low price stock, you're getting 9%. Where would you go? Who's giving you higher? Again, as I had mentioned earlier, always consider liquidity. Um, and of course, people are different. You may have an objective for buying Kakuzi. I don't know, but look at is it something you would want to hold, as Buffett had said, 10 years from now? Yeah. What is happening in that space for you to consider? Yes, they look high priced, and some of them, I mean, are good stocks. I mean, if you look at Standard Chartered, it's a stock that it's a bank that has been in operation for a while, and they keep doing well for themselves, especially from a technological point of view. Their online banking and their systems are fantastic. I mean, you look at uh, which counter do you mention? Capturia. Yeah, you would want to understand the space they're in. I think Kakuzi is more expensive than Capturia, actually, followed by Williamson T. You also want to look at liquidity. Is this a company that I can buy and sell when I need to? You know, I've had cases where somebody bought one of these illiquid stocks, and then they have an emergency and they want to sell. They can't sell simply because there's no buyer. You know, so I mean, those are factors you seriously need to consider.
Okay. I think if I have left out anyone else, you can still reach out to us with your questions. Maybe if Daudi, you have a parting shot.
Uh, Thank you very much. Thank you for your time. Just focus on intelligent investing. Do your homework, then put your money down.
Okay.
Thank you.
From me, always remember that investing without an education and research can actually lead to many regrets. So before you get into any investment, just make sure you try and understand what is happening and do your research. Otherwise, we thank you for showing up and for attending the training. We'll also share the recorded version of this, and you have a lovely Saturday. Thank you. You can
Thank you.
leave at your own pleasure.
Thank you very much.